What's up, investors? Ben here, and welcome to Motivation to Invest. Are we in an EV stock bubble or boom? With EV stocks on a rampage upwards, from Tesla and NIO to Workhorse and all the hot new IPOs. Now, this may seem like a major hype train, and it does seem like the tech bubble we saw in the late 90s. In the late 90s, during the tech bubble, we saw lots of new companies with no previous revenues going public, with nothing but a dream and the word internet in their business plans. Young startup companies such as Pets.com went out of business just 9 months after its much hyped share sale. And many other tech companies followed suit and crashed massively. And even Amazon, which lost over 90% of its share price. Now, during the tech bubble, it wasn't that the internet wasn't going to be massive and going to be everywhere in our lives. Even Jeff Bezos stated he started Amazon after seeing the crazy growth statistics for the internet. So the internet did have some strong economic forecasts backing up the internet's growth. And they were right, the internet did grow massively. Comparing this to the electric vehicle industry, there are many economic forecasts predicting major growth in the electric vehicle industry. So according to Markets in 2019, the number of units of electric vehicles sold was around 3 million units. This is predicted to skyrocket to nearly 27 million units by 2030. This is a compounded annual growth rate of over 21%. Now, of course, that's not anywhere near the speed at which the internet grew.
The wake-up call was finding this startling statistic that web usage in the spring of 1994 was growing at 2,300% a year. Things just don't grow that fast. It's highly unusual. And that set me about thinking what kind of business plan might make sense in the context of that growth.
But it's still a strong economic forecast for the positives of electric vehicles. So why did the crash occur in the late 90s despite the internet being such an amazing technology? Well, Warren Buffett states, price is what you pay and value is what you get. And even a great company is a bad investment if the price is too high. So the further the disparity between price and value, the greater the risk for you investors. So diving into this chart of a classic bubble, we can see that it starts off in the stealth phase. This is the smart money. This is the institutional investors, where they become aware of a company's potential. Then we enter the mania phase, where a company gets media attention, enthusiasm, greed, delusion. People say this is the new normal. And then there's denial, return to normal, fear, capitulation, and then despair. And that's the blow-off phase of the bubble. We saw this with the tech bubble. We saw this with cannabis stocks. We even saw this with Bitcoin a few years back. So this is a common pattern. And my rule is, once it's on mainstream media and mainstream news, don't invest in it. All the good news is baked in to that price, and it'll have a heavy valuation. So the real question is, where do you think we are in this cycle? For example, the legendary investor Warren Buffett, who's arguably the greatest investor of all time, was criticized recently for losing his touch, missing out on great investing opportunities such as Tesla. But in fact, he actually invested into an electric vehicle company many years ago, back in 2008. This company was called BYD, and back then, looking at this chart of a bubble, I would say that this was definitely in the stealth phase of investing, and that is when you can get the greatest returns. So Buffett was definitely in the camp of the smart money. He still got it. So what does this mean? Well, if stocks are highly valued with a lot of froth, this means any bad news or earnings miss could cause their stock to plummet massively. In the words of the legendary investor Howard Marks, who wrote the book Mastering the Market Cycle, the key to great investment success is buying things for less than they're worth, and then being patient enough to let price and value align. This is the essence of value investing. Now you may say, Ben, what about growth investing? Doesn't growth investing mean you can invest into any stock at any price? No, that's not what growth investing means. In the words of Warren Buffett's business partner Charlie Munger, all investing is value investing, as do you ever want to pay a lot more than a company's worth? What growth investors aim to do is to define the future cash flow of the business, the future potential of the business, and they invest more on that basis. Whereas value investors tend to look more at the current prospects of the business. They do use discounted cash flow to forecast the future cash flows of the business, but value investors find it difficult to quantify businesses which are unprofitable or may even have negative cash flow. So their value investors just tend to avoid those types of businesses. Whereas growth investing is actually more difficult because they make the effort to actually try and define future prospects of the company is one of the most difficult things to do. So if you guys are enjoying this video so far, feel free to give the video an early thumbs up. That helps out tremendously with the YouTube AI. And if you're new around here and you still haven't subscribed yet, what are you waiting for? Hit that subscribe button and turn that notification bell on if you want more investing tips and exclusive stock market picks, which I'm personally investing into. Well, as stated previously, there is a lot of economic forecasts which are predicting great EV growth, and there's also a lot of government policy which is moving more towards electric vehicles. So there is some fundamentals. Our goal now is to define how much of these fundamentals are actually valued into businesses and how much is froth and speculation. And that's the difficulty. So reviewing some popular companies, Tesla definitely led the charge as the first mover and leader in mass production EVs. Tesla's also a technology company, so they do Tesla Powerwalls, they do Tesla solar roofs, and are even working on a fully autonomous vehicle. However, we do have many Chinese manufacturers which also have growing sales, but production volumes which are much lower. For example, NIO, which stock has skyrocketed in recent months, reported July sales which increased by 322% year over year. And they followed that up with record August deliveries that more than doubled versus 2019. So that's almost 4,000 vehicles. However, that's still only 10% of Tesla's volume. Then we have the newly public Xiaopeng, which has delivered barely over 20,000 units of its electric crossover and sedan as of late July. But the real risk are those companies which haven't even started production yet they're worth billions of dollars. So there are several companies which plan to begin production soon. These include Rivian, Fisker, Workhorse, Nikola, and Lordstown Motors. But it gets even more frothy, guys. So valuations are most high for these EV startups, as some of these don't even have sales, let alone earnings. Just using traditional metrics to value these companies, such as price to earnings or price to sales, would prove very difficult. Tesla's price to sales ratio is around 16, whereas Nikola, which was previously accused of fraud after many people suggested that they were pushing their truck to actually roll it down a hill rather than it being powered by hydrogen, of which Nikola claimed. Now, this is just a rumor. I'm not saying it's facts at this stage, but still it's interesting to see that stock actually has a higher price to sales ratio than Tesla, which has a proven business model. But the worst we can see is probably Workhorse, which has a price to sales of over 10,000. The majority of that is based upon the possibility that Workhorse might gain a USPS contract to replace a large quantity of their mail delivery vehicles. Now, this still hasn't been decided yet, and that is the major issue with Workhorse. Looking at the price to earnings ratio, even Tesla doesn't look great from this point of view. So Tesla's a price to earnings of over 1,163, and Diamond Peak Holdings has 3,120. So Diamond Peak Holdings is a SPAC which plans to partner with Lordstown Motors in order to go public. So I know what you guys are thinking. Ben, Tesla was considered overvalued for so long, yet many people have made so much money on Tesla stock. Well, to be honest, guys, if you look at the past share price of Tesla, you can see that people who were actually rewarded massively for investing into Tesla were those that invested into it in 2019 or even 2018 and earlier. Back then, growth investors saw the future potential in Tesla as a technology company and invested, despite Elon Musk stating recently that Tesla was just 1 month away from bankruptcy. So it's clear that people who invested back then did take much greater risk and were rewarded handsomely, but still they took greater risk. The dream every investor wants is low risk, high reward, and that's just so hard to achieve in the market. So what are my final thoughts? Well, overall, I do see a lot of froth right now in the tech market and in the EV market. But does that mean we're in a bubble? Well, that's difficult to define. Personally, I'd say the best thing to do is approach every company on a case-by-case basis and analyze them effectively. However, I would say there are a lot of bubble-like investments in many EV startups which have recently IPO'd. So what's the solution for you guys? Because I'm not going to leave you hanging like many other YouTubers do out there. They tell you all the problems and then they say, have a nice day. I'm going to tell you the solution. So I personally am doing what I've always done. I have a wide, diversified portfolio across many industries. Yes, I do have a few speculative EV stocks in my portfolio, but I'm completely aware of the speculation baked into these stocks, and they make up less than 0.5% of my six-figure portfolio. So there's a great quote which states, risk comes from not knowing what you're doing. So the real key here is self-awareness. You need to be aware of your own investing goals, your own financial goals, and the amount you're willing to risk in speculative investments. If you've got a small percent of your portfolio that's for speculative investments, doesn't mean you're going to be stupid with the money and you're going to just put it into anything. You might have 1% of your portfolio which you put into maybe slightly more risky investments and the rest in more safe investments. That's a simple strategy. So in the words of the great investor Howard Marks, he states, when investing, analyze multiple outcomes. So let's say, best case scenario, these companies do really well and you could 5x, 10x your money. Worst case scenario, these companies could go bankrupt or lose 70% of their value. Let's look at the worst case. If these stocks only make up 0.5% or 1% of your portfolio, well, that means you're going to lose 1% of your money or 0.5% of your money. So really the worst case isn't that bad and the best case is actually very good. So that's how you need to weigh up every single investing opportunity. So overall, guys, just keep calm, do your research, and invest safe. With that being said, I hope you guys enjoyed this video, and if you did find some value in this video, then feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you're new around here and you still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button and turn that notification bell on. That way you'll get notified when I'm releasing more investing tips and exclusive stock market picks, which I'm personally investing into. With that being said, I hope you guys have a fantastic day, and I'll see you in my next video. Invest safe.